I am surprised by how enormous the breakout has been. It has been an incredible move. For gold, this is a move that almost mirrors the end of the bull run when we saw the move up in early 2026. Silver continues to move up. Silver coming into a little bit of resistance, high pivot here, low pivot here. So look for silver to get up to about 71 to 71.50. Then it should run into short-term resistance. If that resistance gets taken out, there's a secondary pivot around $79, which would be your next key trend line.
We are very close to a very significant turning point. Either equities start to turn back up and potentially metals take a bit of a breather. Money starts to flow from metals potentially back into stocks or vice versa. We need to see which way these are going to go. So everything has kind of been loading up and creating these extreme kind of cycle lows or cycle highs in the market based on the news that we had. A lot of it mostly around, I think, the kind of treasury bond, the intervention there, the yield control going on. So that's kind of where we're at this week. And we're getting into that make it or break it type of scenario again, where this market needs to find some traction.
Global financial markets are hovering around massive multi-year breakout levels as macroeconomic crosscurrents intensify across all major asset classes. Extreme price volatility in both equities and precious metals signals that a decisive macro trend is rapidly unfolding. Gareth Soloway, chief market strategist and veteran technical trader, alongside Chris Vermeulen, founder and algorithmic specialist, pinpoint key price trajectories. Gold is heading straight toward major overhead technical resistance between $4,700 and $4,760, aligning with its critical 50% Fibonacci retracement zone. While this parabolic run mirrors historic bull market extensions, a shallow consolidation base is necessary to build support before prices can rally higher. Concurrently, silver is projected to test near-term resistance between $71 and $71.50, where a decisive technical breakout opens a clear path toward the secondary pivot target at $79. Meanwhile, the S&P 500 maintains an upward bias as long as it holds above 7,570, targeting a retest of its upper trendline resistance at 7,850. Though a breakdown opens downside risk toward the 7,360 support channel. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
If we flip back, I do want to take a look at the S&P daily chart. We continue to see the S&P 500 basically trading between resistance up here, which is around 78.50, and above support at 73.60 or so. There is the pivot line that we discussed last week, which is right here, and I like to put this in a different color just to kind of show the difference in data points here. And we'll put it in orange, but basically suffice it to say, as long as we remain above 75.70, we'll call it, I would remain bullish into the end of the week, with expectations of a retest of this upper trend line, and then we'll see if we can break out. If we did crack this trend line, it opens up a trap door for a move down into this support at around that 73.60 trend line, all right? And remember where these two trend lines come from. They're not short-term trend lines, and I think this is important to understand is, as a technician, you want to focus on trend lines that have established themselves, that have proven themselves as either support or resistance or both for long periods of time. If they've proven themselves, then we trust them more in the current situation. So if we go here to the charts, we can clearly see that we have this ascending trend line that goes all the way back to 2024. So we're talking a 2+ year trend line here connecting through these pivot highs. Shows that it worked right here in June of 2026 and multiple times here in 2026 August. Now, this other trend line was at one point resistance. It has now proven itself to be technical support. And so again, long-term trend lines, both capping the upside in the near term and the downside, with the pivot line favoring a bullish bias in the near term. All right. Looking at the yields. Now, remember, yields last week were the huge. I mean, that was the story of the week because the U.S. Treasury, the government, went in and started to buy, or said they would buy, $2 billion more in long-dated bonds, right? The 30-year, the 20-year, trying to bring those yields down. what I think was the big story. So that was obviously the headline that most investors saw, that, wow, the Treasury's buying these bonds. Oh my goodness, this is yield curve control, which you're right. But I think the bigger story was that the market basically, it was a one-day event, and then the yields went right back up. And that to me is telling you that, number one, Scott Bissett used a little pea gun, a little like a pellet gun versus a bazooka. And also that the market just kind of was like, really? You think you're going to be able to control 40 trillion in debt with $2 billion in extra buys on the long end here? You ain't doing it. And the market just laughed it off in many ways. And so this is what we're watching here, because now you have this symposium at Jackson Hole where the Fed is all getting together, and we're going to hear on Friday in this speech from Kevin Warsh, what does this mean? Did the Fed go with this plan? Was this the president and the Treasury on their own? What does Kevin Warsh think of that? Will he even speak up against it, or will he just remain silent? What is he going to do? And it's going to be interesting, I have to say. I am looking forward to that speech on Friday. All right. The dollar today getting a tiny little bounce here, so a little bit of an uptick, but not a whole lot going on there. Now moving to some of these other markets here. Gold today continues to push up. It's up another 1.6%. One of the levels I'm watching, and this was that descending trend line that we broke out from, and you can see what a massive move from the breakout. And like I showed you guys, from the lows here at around 3,900, it's now up about 18.5%, almost 20% move. Now, the kicker is this. I am watching this trend line, taking this pivot low before this massive move up and saying, okay, take this, we extend it right through here, and it goes right through this secondary low. So notice pivot low to this little pivot low right there. You see that one right there? And look at where price is coming back to. So we're coming into this level. In addition, if we look at the Fibonacci retrace from our all-time highs down to this low, what do we see? We see that just above that level by a little bit is our 50% retrace. And that also coincides with this pivot high. So right between, I would say between 4,700 and 4,760, there should be major resistance on gold. I will give gold credit, though. I saw the breakout. I am surprised by how enormous the breakout has been. It has been an incredible move. For gold, this is a move that almost mirrors the end of the bull run when we saw the move up in early 2026, right? So here, if we see consolidate and then this move up, I mean, this is getting to those levels. You get up in this range, it's going to match this last little bit. The question, hopefully we don't see, and if you're a gold bull like I am, I don't want to see a drop like this. I want to see a more shallow consolidation building a base before it can run higher. Silver continues to move up. Silver coming into a little bit of resistance, high pivot here, low pivot here. So look for silver to get up to about 71 to 71.50. Then it should run into short-term resistance. If that resistance gets taken out, there's a secondary pivot around $79, which would be your next key trend line.
Short-term equity momentum remains trapped in an aggressive whipsaw pattern, oscillating rapidly between oversold dips and overbought spikes driven by retail FOMO buying. Heavy institutional volume appears to be selling into these temporary relief rallies, keeping broader market volatility elevated while indices search for a cycle bottom. At the same time, benchmark Treasury yields continue pressing against multi-year highs, with long-dated bonds trading over 5% despite central attempts at yield control. These elevated debt yields create intense structural headwinds for equity valuations. A potential downward slide in the US dollar toward its 61.8% Fibonacci retracement level could inject additional fuel into commodity markets before facing a key reversal test. Now, let's get back to the interview.
Now, when we take a look over at the short-term analysis, we have seen the S&P 500 on the 30-minute chart has sold off. It went into an oversold territory. It had a small little bounce, and it went right into overbought territory, meaning FOMO. People were piling in, which is interesting because it wasn't much of a bounce. And then the next day we dipped back into an oversold condition. And then, of course, it bounced and it went right back into another overbought condition, another FOMO condition, which isn't the greatest sign. It's telling us that there's some big sellers selling into the masses as they pile into the stock market. So there is some fear creeping into this market, which we can see with the VIX. VIX hasn't spiked huge, but it has been trading elevated, holding up here. And we just have to see how the market is going to react. Now, overall, we pretty much have most of the asset classes all hitting pretty similar type of scenarios in terms of we have all of the indices hitting a cycle low. They should be finding a bottom this week. So we do have stocks kind of getting oversold, and at this point, we also have precious metals all at a cycle high and running up into resistance areas in measured moves. So we are very close to a very significant turning point. Either equities start to turn back up and potentially metals take a bit of a breather. Money starts to flow from metals potentially back into stocks or vice versa. We need to see which way these are going to go. So everything has kind of been loading up and creating these extreme kind of cycle lows or cycle highs in the market based on the news that we had. A lot of it mostly around, I think, the kind of treasury bond, the intervention there, the yield control going on. So that's kind of where we're at this week. And we're getting into that make it or break it type of scenario again, where this market needs to find some traction. Now, if we take a look at the 10-year note, you can see it is right back up near multi-year highs on the verge of popping and breaking out, which is going to definitely wreak havoc probably for the stock market. It's going to create some extra headwind. And of course, if we look at the 30-year, it isn't quite back up at those highs, but it is darn close to hitting back to multi-year highs again, back over 5%. The news came out, created a little bit of a whipsaw, and it's kind of recoiling right back to naturally where it was. And that's pretty much how news works. News will create a very sharp move in the opposite direction of the trend if it's against the trend. But the underlying trend, you look at all of these moving averages, when the trend is up, naturally, if something hits and spooks the market and creates some selling, it's naturally still going to find support. The tide's still going up. It's just a wave down initially. So that's kind of where the yields are, and they're still trending up. So that is definitely a problem, headwind here with rates going up. And at currencies, let's look at the dollar. The dollar still has potential to run down a little bit lower. If we did a measured move here, this is at the 618, it could push down a little bit lower, and that might send gold, silver miners pushing with the momentum they have to the upside, could continue to send those higher. And then we'll come down to one of these critical support levels for the dollar to see if it is going to reverse and unwind from all this news that we've had based kind of around interest rates. If we go take a look at gold, we definitely have money flowing into gold again today. So we had that first pop, we got this tight pause, and now we're pushing up into getting closer up into this kind of significant pivot high up into this area. And so this is going to be a very significant resistance area on the chart. And we still could see this push up in there. Now, we do have money flowing into gold today, and it's flowing a little bit out of silver. And gold is seen more as that global asset. We talked about this last week and on Friday in the live mentoring session, how gold is kind of where big money goes. Big money that's looking for security, long-term safety, that moves to gold versus silver in a lot of cases, simply because it's slower moving. I wouldn't say it's more solid because it's softer, but it is a more stable asset class. And so that's what we're seeing is just that flight to safety. And high interest rates mean people don't trust the bond market. They don't trust bonds, currency. So they've been moving to precious metals as that play. If we look at silver, we've got silver down 0.3%. Continuing to unwind a little or hold back. Again, it's nowhere near gold. Gold would be equivalent to trading somewhere up here. So silver is definitely underperforming, and we can see that in terms of looking at the previous highs on these charts of where it is at the moment. If we look at gold miners, though, they are kind of like leading the pack. They have really had this strong pop, just like gold that rallied up, had this pause, and it's extending and pushing. We could see gold and silver miners continue to push up with that high momentum move. A lot of money's been piling into these. And this is the kind of the most speculative play. So physical gold is working its way up as the safety play. And then we've got the most leveraged play on this, which are the miners, which are outperforming and pushing even higher. So we got the both extremes of the precious metal space, the more stable asset, gold, and the most volatile miners. So money's kind of flowing into both sides of that. I do like to peek over at platinum and palladium every now and then just to see how they are moving. It's nice to see if they're in line. Again, they're really just, this is platinum here. It's kind of drifting up into resistance, right? We've got this pretty significant pivot level on the chart. So it is moving up into resistance, still a series of lower highs, lower lows. So it's not like it's screaming higher and outperforming. If we look at palladium, Palladium's actually a little more bearish looking. It really is kind of dragging here with a bit of a bearish arm to the downside. There is volume moving in, but it's just struggling to get going. So we're not seeing across the board everything really screaming higher. Really, it's gold is showing some nice steady growth, and then we've got miners are popping and taking off. So again, I don't fully trust this move. Obviously, the fundamental story and all of that stuff is stronger than it's ever been. Every year, it pretty much gets stronger for metals. And we're looking and very close to seeing potentially gold and gold miners turning back into a bullish environment and could lead the way. And that makes sense because that's what the whole world kind of goes for. Big money's looking for safety and a currency, which gold is a currency to protect itself if other fiat currencies are going to print themselves into the hole.
A profound liquidity shift is unfolding across the financial landscape as institutional investors seek shelter from unstable sovereign debt and fiat debasement. Large capital is treating physical gold as the ultimate defensive currency hedge, providing steady accumulation during periods of elevated interest rate uncertainty. Meanwhile, high beta gold and silver mining equities are spearheading the rally with tremendous leverage, breaking out explosively after tight technical pauses and outperforming the broader commodity sector. In stark contrast, industrial metals such as platinum and palladium continue to struggle against persistent overhead resistance. Locked within negative chart structures marked by lower highs and sluggish volume. With equity indices pressing into cycle lows and metals testing extreme cycle peaks, the entire market is approaching a pivotal make-or-break rotation point, where capital will either flow back into stocks or solidify the precious metals leadership trend. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.